So we've had South African assets being sold off during frequent spurts of risk aversion that have come to the fore in recent months. Some buoyancy, though, coming through on Friday, and then that filtering through slightly to this morning as well, where all eyes are on European leaders at this stage. Where are your optimism levels sitting right now?
Hi, Alishia. Well, as far as optimism specifically over the Eurozone, unfortunately, we are not very optimistic. We think that the problems in the Euro are primarily structural, and they're not necessarily related to how high individual countries' debt levels are. The issue with the EMU is really how it's been constructed and the lack of policy options that it affords to countries to get themselves out of situations like debt crises. So there's a summit happening this week. A number of proposals have been put forward by Germany and France, and there's some optimisms that, that the situation could be resolved, and if the market likes the solution that they come up with, then this week, then we could probably see this market optimism continuing. But our view remains and has been for a long time that the problems there are structural in nature, and until the solution is really put in place for the kind of structural issues that they're facing, we think that this crisis is likely to drag on for some time.
With that structural nature of the problem that you've highlighted, Nomvuyo, I mean, to what extent are you holding out for likely further stimulation to be forthcoming from the central banks, given the move we saw by the world's major central banks last week to limit the cost of US dollar swaps, and many saying, they're looking forward to that stimulation being more forthcoming moving forward, if not even QE3 being realized as well?
Well, Alishia, that announcement by central banks took markets by surprise last week, and then since then there have been a number of rumors or growing expectations that they would follow that up with a further move. We don't see any evidence to suggest that that kind of action is imminent. In all likelihood, they would probably continue and wait at least into the new year to see how market conditions either improve or don't. But certainly it was a very welcome move, highly well needed. Interbank lending had been under threat of seizing, as we saw in the last credit crunch, and so these moves to support the global economy and add to liquidity was certainly widely welcomed, and so should the global economy or the banking system show signs of further strain, then there's no doubt that they would probably follow that up with further action, but that isn't something that's not our base case scenario at the moment.
Well, certainly something that we'll be keeping an eye on, because we know of the negative impacts it could have on emerging market trade competitiveness. Taking a look at South Africa specifically within that basket, Nomvuyo, we've got a slew of economic data being anticipated this week, ranging from the business confidence index to reserves data, retail sales, the current account number, and then manufacturing and mining production numbers as well. What specifically do you have your eye on this week?
Well, this week, undoubtedly, the highlight is going to be the quarterly bulletin, and that's the current account number that you referred to. The last print was 3.3% deficit, 3.3% of GDP for the current account, and we're anticipating that in Q3, the current account probably widened a little bit further. We expect that it came under pressure from a combination of a worsening trade account that was fueled by a deterioration in the terms of trade, and also historically, the net services balance tends to widen in Q3 as there's an increase in payments made to offshore non-South African residents. So the combination of the two should have seen the current account widen, and that's going to be the main event risk for the rand this week. So of course, if the deficit comes in much larger than anticipated, we could see a reaction on the currency, and we'd expect it to weaken from the current levels.
Of course, we've got all eyes on this economic data, because a strong debate being had right now in terms of the likelihood of South Africa heading into a recession, given all that's playing out in the Eurozone, which is, of course, our major trading partner. It seems to have receded for the most part down to 35% from 45%. Are you in line with that kind of view that's out there, Nomvuyo?
Yes, I mean, we see the risk as being quite minimal. Obviously, a slowdown in Europe, with them being one of our key trading partners, is going to have a knock-on effect on the South African economy. But I think Standard Bank's forecasts are currently amongst the most conservative in any case. So we see growth of just above 3% for this year, slowing to 3% for next year. So I think those forecasts already have priced in or taken cognizance of the fact that the situation in Europe is not going to be positive for South Africa. Having said that, should Europe slide into a recession, which is what we're anticipating, and should that recession turn out to be much worse than anticipated, then those forecasts that we have in mind would need to be downgraded further.